Picture this. You finally hit the finish line. You retire. The alarm clock is turned off forever. The paycheck stops, but the Social Security deposits start rolling in. For the first time in 40 years, you breathe a sigh of relief. You think you've made it. And then, April 15th arrives. You open your tax return and you see a number that makes your stomach drop. You realize that the government isn't just taxing your IRA withdrawals. They are taxing your Social Security benefits too. You might be thinking, wait a minute. I paid taxes on that money when I earned it back in 1990. Why am I paying again? Welcome to the stealth tax. Here's the scary reality. Up to 85% of your Social Security check can be treated as taxable income, and most retirees don't realize this until it is too late. In the next 12 minutes, I am going to show you exactly how this 85% rule works, because it's not what you think. I'm going to show you the provisional income trap that catches millions of seniors. And most importantly, I'm going to give you 3 specific escape hatches, legal ways to structure your money so the IRS gets less and you keep more. Let's get to work. First, we have to kill a myth that scares everyone. When you hear Social Security is taxed at 85%, you probably panic. You think, if I get $1,000, the government takes $850? No, that is not how it works. If that were true, nobody would bother claiming it. Here is the plain English translation. The 85% refers to how much of your benefit is subject to income tax, not the rate you pay. Imagine your Social Security benefit is an apple pie worth $30,000. The IRS says, okay, 15% of this pie is yours, tax-free. Enjoy it. But the other 85%? We are going to move that slice over to your tax return and add it to your other income. You will pay your normal tax rate on that slice, whether that's 10%, 12%, or 22%. So, the government isn't taking 85% of the money, but the pain is still real. Why? Because when they dump that extra $25,000 onto your tax return, it inflates your total income. It pushes you into higher tax brackets. It can even trigger higher premiums for Medicare Part B. It's a domino effect. But how do they decide if you pay tax on 0%, 50%, or 85%? They use a secret formula called Provisional Income. This is the trap. The IRS doesn't look at your adjusted gross income, AGI, like normal. They calculate a shadow number called Provisional Income. Here is the recipe. Take your adjusted gross income, your wages, pensions, withdrawals. Add any tax-free interest, like municipal bonds, and then add 1/2 of your Social Security benefits. Mix that all together. That number is your provisional income. Now, take that number and look at the ladder of pain. Zone 1. If your provisional income is low, below $25,000 for singles, $32,000 for married couples, you pay 0 tax on your Social Security. Zone 2. If you cross that line, up to 50% of your benefit becomes taxable. Zone 3. If you cross the upper threshold, $34,000 single, $44,000 married, up to 85% becomes taxable. And notice those numbers? $32,000? $44,000? Those thresholds haven't been adjusted for inflation in decades. They are incredibly low. This is where retirees get blindsided. You decide to buy a new car. You pull $40,000 from your IRA to pay for it. Boom, you just spiked your provisional income. Suddenly, your Social Security, which was tax-free last year, is now 85% taxable. You just triggered the tax torpedo. Okay, enough bad news. Let's talk about how to fight back. The goal is simple. We need to lower your provisional income without lowering your lifestyle. Here are 3 levers you can pull. Lever number 1, the magic buckets. Not all money is created equal. Withdrawals from a Roth IRA or a Roth 401k do not count toward provisional income. They are invisible to this formula. If you need $50,000 to live on and you pull $20,000 of it from a Roth, the IRS doesn't see it. It keeps your official income low, which keeps your Social Security tax-free. This is why we love Roths, not just for tax-free growth, but for tax-free flexibility later. Lever number 2, the gap years. Many people retire at 62 or 65, but don't claim Social Security until 70. That gap is your golden window. During those years, your income is naturally low. That is the perfect time to do Roth conversions. You intentionally pay taxes on your IRA money now, while your rate is low, to move it into the Roth bucket forever. By the time Social Security turns on at age 70, you have drained the taxable tank and filled the tax-free tank. You've disarmed the torpedo. Lever number 3. Avoid the income stack. The biggest mistake I see, people turn everything on at once. They start their pension, their Social Security, and their required minimum distributions, RMDs, all in the same year. That creates a massive spike in income. Instead, coordinate them. Maybe you spend down your 401k first. Delay Social Security until 70. By spending the taxable money before Social Security starts, you reduce the RMDs you are forced to take later. Here is the bottom line. Up to 85% taxable sounds like a threat, but really, it's just a math problem, and math problems have solutions. You cannot control the tax code, but you can control the order in which you spend your money. Don't just wing it. Sit down this weekend. List your income sources. Run the provisional income calculation. See if you are in the danger zone. The difference between a plan and a guess can be tens of thousands of dollars over your retirement. If this video helped you see the trap, hit the like button so more seniors don't get blindsided. I'm Walter, and I'll see you there.